86 hours. That is the exact amount of time it takes for the modern banking system to find out your spouse has died. The Social Security Administration updates the federal death master file. The three major credit bureaus run their automated data sweeps at midnight. By Tuesday morning, the credit card you have carried in your wallet since 1998 stops working. Your credit limit drops to zero. Your available purchasing balance vanishes completely. You do not receive a certified letter in the mail first. The local bank manager does not give you a warning phone call. You try to buy groceries or pay the funeral director and the plastic simply declines. This is the unseen trap waiting for every retired couple right now. Let me explain exactly how this system takes your financial dignity when you need it most. The banking industry calls this process automated risk mitigation. You and I call it the widow's penalty. To understand why this happens, you must look at the specific paperwork you signed decades ago. Back in the 1980s, banks wrote their consumer credit contracts to protect themselves aggressively against single income defaults. The federal government stepped in and passed the Equal Credit Opportunity Act. That federal law promised to make consumer credit fair for everyone. Lawmakers buried a specific, highly destructive provision deep inside the federal code. They gave national banks a legal loophole to sever your financial lifeline the moment your household income changes due to death or retirement. The rule sat quietly on the legal books for 50 years. The world around that frozen rule changed completely. In 1985, a bank clerk had to wait for a physical obituary or a returned piece of mail to know a spouse passed away. Today, artificial intelligence algorithms do the job in milliseconds. Financial institutions pay millions of dollars every year for direct access to data streams that monitor your exact life status. They watch your Social Security direct deposits. They track your Medicare billing codes. When the computer system detects a change, the algorithm acts without human supervision. It triggers an automatic, brutal review of your household income. This is the exact reason why seniors are suddenly giving up traditional credit cards this month. They realize that the plastic in their pocket ties them directly to an invisible tripwire. When one spouse dies, the bank instantly strips the surviving spouse of their purchasing power. A widow who never missed a single payment in 40 years suddenly finds the bank treating her like a high-risk borrower. She stands at the pharmacy counter holding a useless card. She has nothing. Let me tell you about Margaret. Margaret is 71 years old. She lives in a brick ranch house in a quiet suburb just outside Cleveland, Ohio. She and her husband Richard bought that exact house in 1989 for $92,000. They raised 3 children in those rooms. They paid off their 30-year mortgage early. They lived a careful, quiet, and deeply responsible financial life. They shared one primary credit card for their daily household expenses. It was a standard cash rewards card from a massive national bank. They opened the account together in 1996. The bank slowly raised their credit limit over the decades until it reached $24,000. They never carried a monthly balance. They paid the bill every single month on the 14th. Then Richard got sick. The heavy medical bills started arriving in the mail. Margaret put the copays and the out-of-pocket hospital costs on that rewards credit card. She knew she could pay the balance off when the life insurance check arrived. Richard passed away on a cold Thursday morning in November. Margaret spent the entire weekend planning the memorial service. On Monday morning, she walked into the funeral home to pay the deposit. The funeral director told her the cost would be $6,500. Margaret handed him the blue rewards card. She knew she had $22,000 of available credit. The credit card machine beeped loudly. The transaction declined. Margaret asked the director to run the card again. It declined a second time. She called the customer service number on the back of the card. A representative sitting in a call center 1,000 miles away told her the bank closed the account. The representative explained that because Richard was the primary account holder, the bank automatically locked the account upon his death. Margaret was an authorized user, not a joint owner. Her access ended the second the bank algorithm swept the federal death registry. The $24,000 safety net vanished instantly. The medical debt remained legally attached to the estate, but the bank erased the credit limit completely. Margaret stood in the funeral home lobby with $200 in her checking account and a dead piece of plastic in her hand. The bank ignored the fact that her name was physically stamped on the front of the card. The bank ignored the fact that she had manually written the check to pay the bill every month for 28 years. The algorithm simply saw that the primary income source disappeared and it executed its aggressive programming. This is the harsh financial reality of the widow's penalty. It removes your leverage exactly when you are most vulnerable. It forces grieving seniors to scramble for cash, beg family members for sudden loans, or take out predatory advances just to bury their husbands. The system is entirely legal and it shows no mercy. You must know the exact law that makes this corporate behavior possible. The overarching federal statute is the Equal Credit Opportunity Act, but the specific weapon the banks use hides inside the Code of Federal Regulations. It is Title 12, Chapter 10, Part 1002. Financial insiders simply call it Regulation B. Section 1002.7, subsection C, governs actions concerning existing open-end credit accounts. The text states that a creditor cannot terminate your account simply because you reach a certain age or retire. That sentence sounds like a solid consumer protection, but the trap lies buried in the very next paragraph. Subsection C2 gives the banking industry a massive carve-out. It states that a creditor may require a reapplication for an open account on the basis of a change in marital status if the credit granted rested in whole or in part on the income of the applicant's spouse. This is the exact mechanism. When you and your spouse originally applied for that credit card decades ago, you likely wrote down your combined household income. The bank approved a high credit limit based on that large joint number. When your spouse dies, your marital status officially changes. The bank uses Regulation B to legally demand that you reapply for the exact same card you have held for 30 years. But you do not reapply with a joint income of $85,000 anymore. You reapply as a single widow with a fixed survivor benefit of $32,000. The bank uses this new, lower income to deny your reapplication entirely or slash your limit to nothing. They also exploit the authorized user loophole constantly. If your spouse applied for the card and simply added you as an authorized user, you hold zero legal rights to the account under federal law. The moment the primary cardholder dies, the contract voids immediately. The bank shuts off the card without hesitation. But there is a specific exception. There is a legal protection that almost no general practice professional mentions proactively. It involves the precise way you structure your joint credit before the crisis hits. If you establish a purely individual account based on your own separate community property assets, you secure your own credit profile. IRS Publication 559 details exactly how executors handle the debts of an estate, but it offers zero protection for your open credit lines. You must assert your individual creditworthiness before the algorithm triggers the sweep. You must understand that automated systems never grant a grace period. They ignore your mourning process completely. They execute the rule strictly. Let us look at the exact numbers. We will run the math so you can see exactly how much money this trap costs you in real life. We will start with the scenario where you take no action. Assume you and your spouse hold a credit card with a $25,000 limit. You carry a current balance of $5,000. Your combined household income equals $90,000 a year. Under these conditions, your credit utilization ratio sits at exactly 20%. You use $5,000 of your $25,000 limit. A 20% utilization ratio builds an excellent credit score, usually landing around 780. Then your spouse passes away. The bank algorithm catches the death certificate. The bank invokes Regulation B and slashes your credit limit down to match your exact existing balance. Your new credit limit is exactly $5,000. Your balance remains $5,000. Overnight, your credit utilization ratio jumps from 20% to 100%. You maxed out your card without spending a single new dime. This mathematical spike triggers a catastrophic drop in your credit score. Your score plummets from 780 down to 610. A few months later, you must replace the leaking roof on your house. The contractor quote is $12,000. You visit a local credit union for a home equity loan. Because your credit score now reads 610, you fail to qualify for the prime interest rate of 6.5%. The credit union classifies you as a subprime borrower. They quote you a punitive rate of 11.5%. On a standard 5-year loan for $12,000, the prime rate costs you about $2,000 in total interest. The subprime rate costs you almost $4,000 in total interest. You lose $2,000 of your hard-earned savings simply because the national bank altered your credit limit. Now let us run the second example. This time, you take decisive action before the algorithm strikes. While your spouse still lives, you apply for an individual credit card in your name only. You use only your strict portion of the fixed retirement income to qualify. The bank approves you for a modest limit of $8,000. You place a small recurring utility bill on it and pay it off automatically. When your spouse passes away, the massive joint card closes, but your individual card remains open and highly active. Your credit score stays perfectly insulated. Your individual utilization ratio remains low. When you walk in to get that exact same roof loan, your score still reads 780. You secure the prime rate immediately. You keep that $2,000 in your own bank account. This is exactly why the math matters. The true penalty goes far beyond the loss of the plastic. The penalty is the complete destruction of your borrowing power at the exact moment your fixed expenses skyrocket. The math proves that relying on a joint account operates as a silent financial hazard. This is not a rare or isolated issue. This is a systemic, calculated trap built deep into the modern banking infrastructure. Millions of seniors walk blindly into this exact scenario every single year. According to demographic data and consumer finance estimates, roughly 800,000 widows and widowers face sudden, unannounced credit card closures annually. That equals nearly 1 million grieving spouses who find their financial safety nets brutally cut. The big banks know exactly what they are doing. They build their risk models to prioritize their corporate exposure over your daily survival. They use the Equal Credit Opportunity Act as a convenient shield. They claim they simply follow federal law by reassessing creditworthiness. The cold reality proves they actively shed older customers who transition to fixed incomes. They want desperate customers who carry revolving debt and pay maximum interest, not careful seniors who pay their balances in full. This is the hidden reason why so many older Americans are quietly giving up their traditional credit cards this month. They walk away from the massive national banks. They refuse to tolerate the constant automated monitoring. They reject the automated limit decreases. They hate knowing that a computer program waits to freeze their assets the moment their health fails. They move their money to local credit unions. They shift to strict cash flow management instead of heavy credit reliance. They protect themselves because they know the federal government will never protect them. The system perfectly extracts wealth from you while you work, and it abandons you completely when you age. You sit at your kitchen table right now, wondering if your own credit card company waits to do this exact thing to you. The widow's penalty represents the biggest threat, but it is not the only one. There are 2 other specific traps that seniors fall into when dealing with traditional credit cards. The first trap involves medical debt conversion. When you use a regular credit card to pay a hospital bill, you instantly strip away every single federal protection attached to medical debt. True medical debt cannot report to credit bureaus if it stays under $500. True medical debt does not carry punishing penalty interest rates by default. The moment you swipe your Visa or MasterCard to pay that hospital invoice, the debt changes its legal character permanently. It is no longer protected medical debt. It becomes standard unsecured consumer debt. The credit card company will charge you 24% interest on it, and they will sue you in civil court if you fall behind. The second trap involves the cross-collateralization clause. Many seniors get a credit card from the exact same bank where they keep their daily checking and savings accounts. They think this arrangement provides convenience. It actually creates extreme danger. Hidden deep in the fine print of your deposit agreement sits the right of set-off. If you miss a credit card payment because you sit in a hospital room, the bank holds the legal right to reach directly into your checking account and take your cash to pay their credit card bill. They do not need a judge. They do not need your permission. They just take the money. You cannot wait for the banking system to develop a moral conscience. You must protect your own household this week. I am going to give you 4 exact instructions. Do them in order. Step 1 takes 5 minutes and costs absolutely nothing. Pull out your current primary credit card. Turn it over. Call the customer service number printed on the back. Ask the representative one specific question. Am I a joint account holder with contractual liability, or am I just an authorized user? If they tell you that you are an authorized user, you stand in immediate financial danger. That card shuts off the exact day your spouse dies. Step 2 requires action. If you act merely as an authorized user, you must apply for a new credit card in your own individual name today. Do not apply for another joint account. Apply using your own name, your own social security number, and your own distinct income. Even if the approval limit hits only $2,000, you need an independent line of credit that no bank algorithm ties to your spouse's mortality. Step 3. Move your primary checking and savings accounts to a completely different institution than the one that issues your credit card. Break the financial chain. If your credit card sits with a massive national bank, move your daily cash to a local credit union or a state-chartered community bank. This maneuver completely eliminates the bank's ability to use the right of set-off. They can no longer reach into your checking account to pay themselves without securing a formal court judgment. Step 4. Go online to annualcreditreport.com. Download your official federal credit report. Look very closely at the section listing your open accounts. Save that your individual accounts report strictly under your own file. If you see joint accounts you did not realize were joint, you must actively separate them. You build a firewall around your dignity by taking control of the paperwork before the crisis ever arrives. You spent your entire life playing by the strict rules. You paid your property taxes, you paid your mortgage, you kept your promises. It is deeply offensive that the banking industry uses those exact same rules to strip your financial independence when you are most vulnerable. I know you spend time watching financial content online. There are dozens of channels pushing videos designed to confuse you, to alarm you, or to sell you a complicated annuity. Dark Macro by Walter Barron operates differently. I do not charge you for anything. I do not run a private course. I do not have a product to sell you. The only reason this channel exists is to make sure you have the exact same information that the people inside the system have always had, and that ordinary seniors almost never hear. The only thing I ask in return for this research is that you subscribe to Dark Macro by Walter Barron, so that the next video finds you before the deadline does. Drop your state in the comments below so I know where you are watching from. In the next video, we examine the new probate rules targeting middle-class homes. Guard your resources carefully. This video is for educational purposes only and does not constitute formal legal or financial advice.